Dear students, we have discussed about the future value, present value, one period, multiple periods, then calculation of rate, calculation of interest rate, calculation of the time. Then we calculated the frequency of compounding. It can be annually, semi-annually, quarterly, monthly, daily, continuously. The impact we have seen. We saw the APR and EAR. In all these functions, we tried to do the solution through the financial calculator and manually. Now it is the point for, and before we start this 4.4, that is for multiple cash flows. It is annuity and perpetuity. Before going to this section, all these calculation will be done in the spreadsheet, very easier way, and we will see how to do it also. Let us do the annuity and perpetuity complete, then we will go to the spreadsheet. Perpetuity is a constant stream of cash flow that lasts forever. For example, your father will be interested to set up a prize money in College of Business Administration because you are studying here. Your father will be out of courtesy. He will contact the university to set up a prize money. Every year, that the number one ranked student will get a cash prize of 10,000 reals as a token of appreciation. Your father wants to set up a prize money of 10,000 every year. Then what he will do? University will set up to will contact a bank, or your father might contact a bank or an insurance company who will set up a perpetuity in College of Business for 10,000 annually. How much your father has to invest now, so that the insurance company will pay every year the number one ranked student a 10,000 cash prize on the graduate ceremony. This is perpetuity. Same like, for example, you say uh, in your village, again your father will go and set up a kind of a fund that every year for the renovation and for the development of the mosque, he will set up, for example, 100,000 forever. Then he has to contact a bank or an insurance company who will take the responsibility, taking a specific money from your father. Every year it will provide this much of grant to the mosque for repair and maintenance. This is one. This is called constant stream of cash flow that lasts forever. No stop. Then it is a perpetuity. The second one is growing perpetuity. What is this? Your father will go one step further. He says it's not 10,000 every year, it will grow 10% every year. 10,000 grows 10% every year. That means 10,000 next year, 10% second year growth means 11,000 in the second year. In the third year, 12,110 in the third year. Like that, it will grow every year forever. Then what the bank will charge? This is called perpetuity. Now, annuity. Annuity is a stream of constant cash flows that last for a fixed number of periods. For example, you buy a bond. Bond will give you coupon for 10 years semi-annually. That means every 6 months it will pay you the coupon. 10 years, yearly twice, 20 times the coupon will be paid to you. This is an annuity. What is the difference between perpetuity and annuity? Perpetuity is fixed cash flow, fixed stream of cash flow forever. Annuity, fixed amount of cash flow for a fixed number of periods. Growing annuity again, the annuity will grow at a fixed rate of interest, fixed rate for fixed number of periods. For example, 1000 after 1 year, 1100 after 2 years, like that. So if it is a perpetuity, it is forever. You see, cash flow 1, cash flow 2, cash flow 3, cash flow 4, cash flow 5. It grows forever. Dot, dot, dot. There is no end. Then the formula is quite straightforward. Here, your father was interested for how much? 10,000 per year. He was interested to set up a fund with a bank where the bank will give 10,000 to prize money to the number 1 ranked student in the graduate day. Then bank will do what? He will calculate every year how much to pay? 10,000. Cash flow is 10,000. Divided by bank will charge a rate of return. For example, 10%. So 10,000 divided by 10% will be the amount your father has to pay to the bank. 10,000 divided by 10% will be the, so it will be how much? It will be 100,000. Your father has to set up 100,000 in a bank. Bank will give 10,000 every year to the first graduate student of the college on that graduate ceremony. Alright, so this is the way perpetuity is calculated, cash flow divided by cost of capital. Too straightforward. Another example, what is the value of British console that promises to pay $15 every year forever? So perpetuity is the example like this, to a college, to a grant, British console, to some kind of developmental organization, charitable organization, to a mosque. So wherever you are interested to do some charitable job, you can do with a bank or an institution. They will decide. Very simple formula is the cash flow divided by cost of capital. Here cash flow is $15, cost of capital is 10%. So what will be the formula? Cash flow divided by 10%. Here, how much will be that? 15 divided by 10% is equal to 150. So if 150 fund is given now, British console will pay $15 every year forever. Alright, clear? Now, growing perpetuity. Same thing, but the cash flow will grow in a continuous way. First year, it is cash flow C. Second year, C multiplied by 1 plus Z. Third year, C multiplied by 1 plus Z square. Like that. Then what will happen? Simple. The original formula will C divided by 1 plus R, present value. C multiplied by 1 plus Z divided by 1 plus R to the power square. C multiplied by 1 plus Z to the power square divided by 1 plus R to the power 3. So the numerator 1 plus Z can be taken as common. Using the mathematical interpolation, you can get the formula C divided by R minus Z. This is the dividend discount model we will see in the next chapter. C divided by R minus Z. C is the, normally in dividend discount model, we use this formula. C is the dividend, current dividend, divided by R is the cost of equity, G is the growth in the dividend. Will give you the present value of the stock or the valuation of the stock. Example here, the expected dividend next year is 1.30 and dividends are expected to grow at 5% forever. So the formula will be, what will be the price you are about to pay for this stock if the rate of return is 10%. Simple, 1.3, 1.3 to the power multiplied by 1.05, third year 1.3 multiplied by 1.05 to the power square, like that it will continue. So the formula will be cash flow divided by expected cash flow next year, that is D1 divided by R minus G. R is 10%, G is the growth in dividend 5%. So if a company is paying $1.3 dividend next year and dividends are expected 5% growth, then you are ready to pay $26 for this stock. So this is called perpetuity with a growth. I hope it is clear. Now let us take annuity. In annuity, what happens? Cash flow for a fixed time period. Fixed cash flow, fixed time period, fixed maturity. Say for example, 1, 2, 3, 4 number of year, but the number of years are fixed, T, up to T number of years. Then the formula is, go to the the basic time value of money formula says the present value of annuity is equal to cash flow divided by R 1 minus 1 divided by 1 plus R to the power T. Cash flow divided by R 1 minus 1 divided by 1 plus R to the power T. For example, cash flow is 1000, R is 10%, T is 10 years, then the present value will be 10,000 divided by 10%, 1 minus 1 divided by 1 plus 10% to the power 10. Example here, if you can afford 400 monthly car payment, so you want to pay 400 monthly. How much worth of car can you afford if interest rates are 7% on 36-month loan? You see here, the question is twisted here. Percentage is given annually. The frequency of compounding is monthly. So what you will do? Simple. Formula is very simple. C divided by R multiplied by 1 minus 1 divided by 1 plus R to the power T. Here C is 400, T is 36 months, R is 7% divided by 12 because monthly compounding. So use it. 400 up to 36 months you have to pay $400. What will be the present value? 400, that is the cash flow, divided by 7% divided by 12, whole multiplied by 1 minus 1 divided by 1 plus R. R is 7% divided by 12 to the power 36 is equal to 12,954.59. So you can get a car worth of 12,954 now. So this is the way we calculate the annuity. Now it is the fixed annuity. 400 every month, 400 you are paying. It can be, another example is given here. What is the present value of 4-year annuity of 100 per year that makes its first payment 2 years from today if the discount rate is 9%? So 2 years from today means in the time value table you can see 100 after 2 years, 100 after 3 years, 100 after 4, 100 after 5. So its present value after 1 year will be calculated as 100 divided by 1.09, 100 divided by 1.09 square, 100 divided by 1.09 cube, 100 divided by 1.094 is equal to 323.97 after 1 year. Now you want right now means 323.97 divided by 1.09 will be the present value today, 297.22. So these are the two examples for annuity. I think will make you crystal clear about a fixed amount annuity. Now let us take growing annuity. Here what happens? Fixed number of years, fixed amount of annuity with a growth. Like C, second year C multiplied by 1 plus Z. Third year C multiplied by 1 plus Z square. Fourth year C multiplied by 1 plus Z cube. Like that. In the T year, C multiplied by 1 plus Z to the power T minus 1. And the formula here is, again, C divided by 1 plus R after 1 year. C multiplied by 1 plus Z divided by 1 plus R square. Like that, C multiplied by 1 plus Z to the power T minus 1 divided by 1 plus RT. Putting applying the mathematical formulas and the interpolation, we get the formula as C divided by R minus G. That is the perpetuity form. If there is a growing perpetuity, the formula is C divided by R minus G. Remember, multiplied by 1 minus 1 plus G divided by 1 plus R to the power T. Let us take an example. A defined benefit retirement plan offers to pay 20,000 per year for 40 years. So, your retirement plan is offering you 20,000 per year for 40 years. And increase the annual payment by 3% each year. What is the present value of retirement if the discount rate is 10%? So, what the bank will charge from you right now? Present value. It is offering you 20,000 per year for 40 years with an increase of 3% every year. First year 20,000, second year 20,000 multiplied by 1 plus 0.3 because 3% growth will be there like that. So first year 20,000, second year 20,000 multiplied by 1 plus 0.3 as I told you. Third year 20,000 multiplied by 1.03 to the power square. Fourth year 20,000 multiplied by 1.03 to the power 3 like that. In the 40th year 20,000 multiplied by 1.03 to the power 39. What is the value of today? Very simple. Cash flow divided by R minus G. First cash flow is 20,000 divided by R minus G. R is 10%, G is 3%. Whole multiplied by 1 minus 1 plus growth divided by 1 plus R to the power T is equal to 40. 265,121 you have to pay right now. If you pay 265,121 to the bank, bank will pay you 20,000 per year with a growth of 3% up to next 40 years. Sorry, yes, up to next 40 years. Number 2, you are evaluating an income generating property. Net rent is received at the end of the year. The first year's rent is expected to be 8,500, which will increase 7% each year. What is the present value of that income stream for 5 years if the discount rate is 12%? Very simple. First year rent will be, end of first year you will get 8,500. Second year rent will be 8,500 multiplied by 1.07 because growth is 7%. Third year, and that is equal to 9095. Third year rent will be 8,500 multiplied by 1.07 to the power square is equal to 9731. Fourth year will be 8,500 multiplied by 1.07 to the power 4, 10,412. And fifth year will be 8,500 multiplied by 1.07 to the power 4 is equal to 11,141. You want the present value today. You can use the formula. No need to do all this kind of thing. Simply you can use the formula. What is that? Cash flow, that is 8,500 first cash flow divided by R minus G, 12% minus 7%, multiplied by 1 plus G, 1 minus 1 plus G to the power T divided by 1 plus R to the power T. So you can use this formula and get this 1 minus 1 plus G to the power T, 1 plus R to the power T. That will also give you the same value, which is 34,706. So loan amortization we will take in the next part of the recording. Let me stop the recording here.